In The Future for Investors, Jeremy Siegel confronts the misconception that the best investment opportunities lie with new, fast-growing companies and industries. The first chapter, The Growth Trap, introduces the core concept that while technological advancement and rapid economic growth have historically transformed the world, they have not necessarily translated into the best investment returns. Siegel debunks the idea that investing in the latest and fastest-growing companies ensures superior returns. Instead, he posits that these investments often fall into a growth trap, where the high price paid for hot stocks in trendy industries often leads to disappointing returns. He argues that many of the best-performing investments are found in slower-growing countries and shrinking industries. Using historical data and case studies such as IBM versus Standard Oil, now ExxonMobil, Siegel demonstrates that companies with lower growth often provide higher returns due to their more reasonable valuations. He emphasizes the importance of dividends in total returns and suggests that investing in lower valuation companies with good dividends is often more profitable in the long run. Siegel also touches on the impact of demographic shifts and globalization on investment strategies. He predicts a future where the economic center will shift eastward to countries like China and India, and stresses the importance of understanding these trends for portfolio positioning. However, he warns against the growth trap in this context too, indicating that the fastest-growing countries may not provide the best investment returns. The chapter sets the stage for the rest of the book, where Siegel plans to delve deeper into investment characteristics to seek or avoid, the importance of dividends, his vision of the future economy and financial markets, and how to structure a portfolio for upcoming changes. His main message is clear. In a rapidly changing world, investors should be wary of the allure of growth and instead focus on the tried-and-true principles of investing in well-valued companies with a track record of delivering dividends and solid performance. Chapter 2, titled Creative Destruction or Destruction of the Creative, examines the concept of creative destruction in capitalism, as described by Joseph Schumpeter. The author, initially an advocate of broad index investing, shares a revelation. Stocks of the original S&P 500 companies might outperform the continually updated index. The chapter questions the efficacy of the common buy-and-hold investment strategy. The author once suggested that investing in broad indexes like the S&P 500, which regularly includes new companies, was optimal. This strategy aligns with the economy's dynamic nature, where old firms fade and new ones emerge, a process known as creative destruction. However, the author's research indicates that original companies of the S&P 500 provided better returns than the updated index. This finding was based on the analysis of portfolios comprising original S&P 500 firms compared to the performance of the continually updated index. The original firms outperformed the new additions. The reasons for the underperformance of the updated index are explored. The author criticizes the approach of equating market value with investor return, highlighting the significant impact of dividends and reinvestments on long-term performance. Additionally, the inclusion of a company in a popular index like the S&P 500 can artificially inflate its stock price due to increased demand, often leading to overvaluation. The chapter concludes with reflections on investment strategy implications. While creative destruction drives economic growth, it has a different impact in capital markets, often leading to overvaluation of new creative firms. The findings challenge the necessity of continually updating one's portfolio for superior returns, suggesting that a buy-and-hold approach, especially with original S&P 500 firms, could be more effective for long-term wealth accumulation. In Chapter 3 of Finding Corporate Eldorados, the author challenges the traditional divide between value and growth investing, citing Warren Buffett's perspective that growth is a component of value. The chapter focuses on the long-term performance of the original S&P 500 firms, particularly highlighting the extraordinary success of Philip Morris, now Altria Group. Despite facing significant legal challenges, the company exemplifies how negative public perception can lead to undervalued stocks, offering high returns for investors who stay the course. The chapter introduces the basic principle of investor return, BPIR, which asserts that a stock's long-term return is influenced not by the actual growth of its earnings, but by the growth relative to market expectations. This principle emphasizes the significance of the price-to-earnings (PE) ratio in gauging these expectations. High PE ratios suggest high anticipated growth and vice versa. An analysis of top-performing firms reveals a dominance of consumer brands and pharmaceuticals, with these sectors offering recognizable, trusted brands that command higher profit margins. These companies typically have slightly higher than average PE ratios, but deliver much higher than expected earnings growth, especially when dividends are reinvested. The chapter warns against investing solely based on growth prospects and advocates for a growth at a reasonable price strategy, focusing on stocks with strong growth prospects but reasonable prices. The key lessons for investors include the superiority of well-established firms with strong brands and the importance of realistic pricing when selecting stocks. The chapter concludes by suggesting a shift from individual stock analysis to broader industry or sector-based investing trends. Chapter 4 of the book debunks the misconception that investing in high-growth sectors ensures high returns. It critiques the popular strategy of sector-based investment, emphasizing that a business's physical growth doesn't guarantee investor profits, as illustrated by the contrasting performances of the financial and energy sectors since the S&P 500 index's inception. The chapter introduces the Global Industrial Classification Standard, GIS, which classifies economies into 10 sectors, showing no strong correlation between a sector's expansion or contraction and investor returns. This is highlighted by the underperformance of new firms across sectors due to investor overvaluation. Specific sectors like technology, energy, financial, healthcare, consumer, discretionary and staples, industrial, materials, telecommunications, and utilities are analyzed for their historical performance and impact on investors. Each sector's unique challenges and transformations are discussed, illustrating how factors like management strategies, regulatory changes, and market expectations influence their performance. The chapter concludes that growth in market value and investor returns often diverge, especially in the long run. It warns against the growth trap, where investors chase rapidly expanding sectors, often leading to disappointing returns. Instead, it suggests focusing on sectors with consistent quality product delivery, global brand recognition, and reasonable valuations. Healthcare, consumer staples, and energy are highlighted as historically favorable sectors. The overarching lesson is that long-term investment success requires looking beyond sector growth and considering factors like the impact of new firms and dividends on returns. Chapter 5 of the book, titled The Bubble Trap: How to Spot and Avoid Market Euphoria, discusses the dangers of investing during market bubbles, particularly focusing on the tech bubble of the late 1990s and early 2000s. The chapter opens with a quote reflecting the euphoric sentiment surrounding tech stocks during the Internet revolution. The author argues that while it's challenging to identify bubbles, as even experts like Alan Greenspan have admitted, certain telltale signs can indicate an overvalued market. These signs include wide media coverage, astronomical valuations not supported by traditional metrics, and a general belief that the rules of investing have fundamentally changed. The chapter offers several lessons on avoiding market euphoria. Lesson 1. Valuations are critical. Investors should beware of extremely high price-to-earnings ratios. The author uses AOL as a case study to illustrate how stocks can be grossly overvalued. Lesson 2. Never fall in love with your stocks. Emotional attachment can cloud judgment. The author received intense backlash for suggesting that internet stocks were overvalued, showing how emotional investors were about their investments. Lesson 3. Beware of large, little-known companies. The author discusses how companies like Cisco reached trillion-dollar valuations despite many investors not fully understanding what they did. Lesson 4. Avoid triple-digit PE ratios. The chapter warns against investing in companies with excessively high PE ratios, even if they are expected to grow significantly. Lesson 5. Never short sell in a bubble. While it might be tempting to bet against overvalued stocks, the author advises against due to the potential for unlimited losses and the unpredictable nature of market timing. The author advises that the best course of action when identifying a bubble is to step back and avoid investing in the overhyped sector. Even if you own stocks caught in the frenzy, it's wiser to cash in and not look back, as the long-term fallout can be severe. The chapter closes by emphasizing that while it's exciting to witness the birth of new technologies and investment opportunities, it's crucial to remain cautious and remember that valuations always matter. Chapter 6 explores the high-risk world of initial public offerings, or IPOs, likening investing in them to playing the lottery. The allure is understandable. A few, like Microsoft and Intel, have turned modest investments into fortunes. However, the majority of IPOs underperform established market stocks. Analyzing nearly 9,000 IPOs since 1968, the author finds that while there are some stellar successes, the vast majority lag behind the market by significant margins. The chapter also highlights the role of insiders, founders, venture capitalists, and investment bankers, who often reap substantial profits from IPOs, sometimes at the expense of general investors. Instances like Global Crossing illustrate how insiders might sell their shares for massive gains before a company's downfall. This pattern suggests that while IPOs are crucial for economic innovation, they are not typically sound investments for the average buyer. Additionally, the text warns against the frenzy of hot IPO markets, like the late 1990s tech bubble, where speculative investments often led to dramatic losses. The chapter argues that although a few IPOs can yield extraordinary returns, the overall risk and lower average performance make them an unwise choice for a robust, long-term investment strategy. It advocates for a cautious and critical approach to IPOs, urging investors to learn from historical speculative manias and focus on more reliable investments. Chapter 7, Capital Pigs, Technology as Productivity Creator and Value Destroyer, challenges the notion that early investment in technology guarantees wealth. It highlights the difference between economic and profit growth, demonstrating that advancements can sometimes erode profits. Using examples from the data storage and telecommunications industries, it shows how remarkable technological progress hasn't always translated into profit due to overcapacity and intense competition. The chapter introduces the fallacy of composition, explaining that while individual firms may benefit from new technologies, widespread adoption erodes these advantages, transferring benefits from producers to consumers in the form of lower prices. Warren Buffett's experience with Berkshire Hathaway exemplifies a strategic understanding of this concept, avoiding investments in productivity technology that wouldn't yield long-term profits in a competitive market. The text also discusses how the internet has increased market competition by lowering search costs and increasing price transparency. It illustrates this with the airline industry, where online booking platforms increased consumer access to cheaper fares, eroding airline profits despite initial cost savings. Concluding, the chapter asserts that technology should enhance a company's core competencies rather than dictate its direction. Excessive investment in technology can lead to overcapacity and reduced profitability. A disciplined, moderate approach to technology investment, aligned with strategic goals, is crucial to avoiding value destruction. Chapter 8 of the book highlights an unconventional investment philosophy. Investing in well-managed companies within stagnant or declining industries can be more profitable than investing in average companies in growing industries. The chapter underscores the success stories of Southwest Airlines, Walmart, and Nucor, demonstrating how each of these companies thrived in challenging sectors by focusing on productivity, cost management, and unique strategic approaches. Southwest Airlines succeeded in the tumultuous airline industry by maintaining a simple, low-cost operational model and focusing on their core competency as a no-frills airline. Their strategy of using a single aircraft type and offering straightforward services allowed them to outperform competitors and become one of the most successful investments over a 30-year period. Walmart's journey from a small store to the world's largest retailer is attributed to its strategic expansion and efficient management. Sam Walton's relentless focus on learning from competitors, technological advancements, and a unique distribution strategy enabled Walmart to offer consistently low prices and achieve an impressive productivity edge. Nucor, in the declining steel industry, showcased that technology, while important, was not the sole reason for its success. The company's culture, focus on worker incentives, and minimization of corporate hierarchy contributed significantly to its ability to outperform the industry. The chapter concludes by emphasizing that companies capable of maximizing productivity and developing competitive advantages, regardless of the industry's overall growth, can provide superior investment opportunities. These firms often outperform the market by focusing on efficient operations, cost management, and a strong commitment to their core competencies, proving that sometimes the best investments are found in the least expected places. Chapter 9 examines the vital role of dividends in stock returns and corporate governance. Highlighting Microsoft's substantial dividend payout in 2004, the chapter establishes dividends as a primary source of stockholder returns, with historical data from 1871 to 2003 showing 97% of total after-inflation stock accumulation stemming from reinvesting dividends. It demonstrates that companies with higher dividend yields consistently offer better returns, challenging the misconception that dividends limit growth. Despite their importance, dividend yields have declined due to beliefs about growth opportunities, adverse tax treatment, and the rise of management stock options, which shift focus from dividends to stock price enhancement. The chapter critiques these reasons, particularly the belief that dividends restrict growth, presenting evidence that firms with robust dividends often outperform others. Warren Buffett's Berkshire Hathaway is discussed as a unique case where not paying dividends works due to Buffett's specific strategies and shareholder alignment. The decline in dividends is linked to U.S. tax policies and the proliferation of stock options, which discourage dividends. The author advocates for reforms, including tax-deductible dividends for corporations and reduced reliance on stock options for management. In conclusion, dividends are reaffirmed as essential for reliable stock returns and robust corporate governance. They ensure company profitability and build investor trust, making them critical for market stability. The chapter calls for reforms to promote dividends and better align management's and shareholders' interests. Chapter 10 emphasizes the critical role of reinvested dividends in safeguarding investments during bear markets and boosting returns. It argues that dividends are paramount in wealth creation, outperforming inflation, growth, and valuation changes. Historical evidence from the Great Depression demonstrates that long-term investors who reinvested dividends experienced substantial annual returns, outperforming bonds. The chapter posits that bear markets, typically seen as destructive, can actually benefit those who reinvest dividends. As stock prices drop, dividend yields rise, allowing investors to acquire more shares and benefit when the market recovers. This makes reinvested dividends both a bear market protector and a return accelerator. One case study highlighted is Philip Morris during its difficult times in the 1990s and early 2000s. Despite numerous challenges, investors who consistently reinvested dividends saw their investments grow and eventually outperform the market. Additionally, the chapter discusses investment strategies like the Dow 10 or Dogs of the Dow, which focus on buying high-yielding, often undervalued stocks. These strategies benefit from the protective and accelerating effects of reinvested dividends. The chapter also briefly mentions dollar cost averaging, share repurchases, and other cash-generating investments like REITs and junk bonds, which can similarly benefit from reinvested yields. In essence, this chapter highlights the power of dividends and their reinvestment, particularly during bear markets. It suggests that with patience and discipline, what is often feared as downturns can be opportunities for significant wealth growth through the strategic use of reinvested dividends. Chapter 11 discusses the significance of corporate earnings as the primary source of shareholder returns. It begins with a real-world scenario of Intel's earnings announcement to illustrate how the market reacts to earnings reports, emphasizing the difference between reported earnings and operating earnings. The chapter acknowledges the complexity and confusion surrounding earnings details, including issues like expensing employee stock options and pension costs. These not only affect investor perception and corporate valuation, but also stir political debates. The chapter explains two main methods of reporting earnings: net income or reported earnings and operating earnings. Operating earnings are preferred by analysts and investors because they exclude one-time items, but are also prone to manipulation. The debate around expensing employee stock options is highlighted, with the author advocating for recognizing them as an expense to reflect true profitability. Pension costs, particularly for defined benefit plans, are discussed as another complex aspect of corporate earnings, pointing out the long-term shift towards defined contribution plans. Standard & Poor's introduction of core earnings is presented as a solution to standardize earnings measurements, aiming to provide a clearer picture of a firm's profitability. The chapter concludes by acknowledging that while earnings reports can have biases that either inflate or understate profits, they generally offer a reasonably accurate picture of a company's financial health. The author also notes that dividends can be a more reliable measure of corporate performance compared to earnings figures. The chapter ends with a caution about governmental accounting practices for pensions, suggesting they pose a larger economic risk than corporate accounting issues. Chapter 12 explores the historical performance of the stock market and its future amidst demographic shifts. It starts by acknowledging the unpredictability of history, but emphasizes its importance in understanding future market behavior. Historical data reveal a remarkably stable after-inflation return of 6.5 to 7% annually for diversified stock portfolios since 1802, a phenomenon the author refers to as Siegel's constant. Despite societal and economic transformations, equity returns have been surprisingly persistent. However, a looming demographic realignment, known as the age wave, threatens the long-standing stability of equity returns. The increasing number of retirees and the massive sell-off of assets could potentially depress asset prices and undermine retirement security. The chapter discusses the equity risk premium and highlights that while stocks are indeed riskier than bonds in the short term, their risk decreases significantly over longer periods due to mean reversion of equity returns and better incorporation of inflation. Worldwide equity returns reinforce the superiority of stocks, debunking the notion of survivorship bias by showing consistent outperformance across various countries. Despite this, the author cautions against blindly extrapolating past performance to predict future returns, citing examples like Japan's lost decade and the 2000s tech bubble. Finally, the chapter introduces the demographic challenges ahead, promising a deeper exploration in subsequent chapters. It hints at potential global solutions to counteract the demographic impact, including the rapid economic growth of developing nations and the spread of knowledge and technology, which could fuel unprecedented global economic growth. This suggests a potential mitigation of demographic concerns, offering a hopeful perspective on the future of stock market returns. Chapter 13 discusses the predictability of future demographic trends. Demographers, unlike economists, have a strong track record of forecasting future population profiles due to known current age distributions. The chapter focuses on the significant demographic shift resulting from the post-World War II baby boom in America, leading to an aging population and a shrinking workforce. This shift is certain and will substantially impact public pension funds, like Social Security, as baby boomers retire. The author warns of a looming supply and demand issue in capital markets. As the aging population begins selling assets to fund retirement, there may not be enough buyers, potentially leading to decreased asset values. This trend is not just a U.S. issue, but a global phenomenon, with countries like Germany and Japan experiencing even more drastic demographic shifts due to lower fertility rates and longer life expectancies. The Social Security crisis in the U.S. is also discussed, highlighting the system's historical funding mechanism and the challenges it faces due to demographic changes. The chapter suggests that traditional investments might suffer due to these demographic shifts, but Treasury inflation-protected securities, TIPS, could offer a safer haven. The chapter concludes by emphasizing the need for understanding and addressing the implications of the coming age wave. It sets the stage for further discussions on potential solutions to the challenges posed by the aging population in future chapters, indicating that the demographic realities will have profound effects on the economy, financial markets, and societal structures. Chapter 14 explores the challenges of aging populations in the developed world, critiquing common solutions like benefit cuts, tax increases, and mandated savings. The author uses a model to show that to maintain living standards, retirement ages must significantly increase due to demographic shifts and longer life expectancies. This change would reverse the trend of earlier retirement seen since the Industrial Revolution, potentially leading to a generational clash over resources. The chapter argues that commonly proposed solutions, like increased savings and productivity, higher Social Security taxes, and more immigration, are insufficient or flawed. It suggests that increased savings don't necessarily lead to higher productivity, a key to mitigating the age wave. Instead, innovation and new ideas, not capital accumulation, drive productivity gains. However, even with potential increases in productivity, the challenge posed by the aging population is too significant to overcome through these means alone. The author concludes that the real solution may lie in the economic growth of the developing world. Countries like China and India, with their younger populations, could help balance the demographic scales, offering a more optimistic outlook on handling the global aging crisis. The chapter sets the stage for a further discussion on leveraging the developing world's growth to address the aging challenge in the developed nations. Chapter 15 discusses the global solution as a response to the challenges posed by an aging developed world. The chapter argues that while the developed world faces demographic challenges with an aging population, the developing world, especially countries like India and China, has a predominantly young population. These younger populations can produce goods and buy assets from the older populations in developed countries, creating a symbiotic economic relationship. This exchange is facilitated by financial markets and is exemplified by the way Florida's elderly population is supported by younger people from other states. The key to this global solution is the sustained rapid growth of developing countries, which is currently being witnessed in China and India. If these countries continue to grow, they can significantly alleviate the pressures of an aging population in the developed world. The chapter emphasizes the transformative power of the communications revolution, comparing the potential impact of the internet and related technologies to historical innovations like the printing press. Looking forward, the chapter suggests that China and India's economies will become dominant and that assets in the developed world will increasingly be owned by investors from developing nations. Despite potential political resistance to these changes, the chapter argues that this integration should be viewed as an opportunity for growth and prosperity. Embracing globalization, encouraging free trade, and supporting the economic rise of the developing world are posited as essential for a prosperous future. Chapter 16 emphasizes the importance of global investing, particularly highlighting the misconception that economic growth equates to good stock returns. The author uses China and Brazil as case studies to illustrate the growth trap, showing that despite China's rapid economic expansion in the 1990s and early 2000s, its stock market provided poor returns, whereas Brazil's troubled economy offered surprisingly high returns to investors. This paradox is attributed to the overvaluation and excessive investor excitement in rapidly growing markets. The chapter discusses the home equity bias, where investors prefer domestic stocks due to perceived risks and familiarity, but argues that long-term global diversification is more beneficial. Despite rising correlations between global markets, the author recommends maintaining a significant portion of one's portfolio, about 40%, in international equities to maximize diversification and returns. To achieve broad international exposure, the chapter suggests using global index funds and exchange-traded funds, ETFs, for their low costs and broad market access. Overall, the chapter advocates for a balanced, globally diversified approach to investing, cautioning against the allure of rapid growth markets and emphasizing the importance of relative growth expectations over absolute growth in predicting stock returns. Chapter 17, the last chapter of the book, discusses how investors can effectively plan their equity portfolios for the future. The author, initially a proponent of broad index funds for equity investment, now believes in complementing this approach with additional strategies for better returns. These strategies are encapsulated in the DIV mnemonic: dividends, international, and valuation. Dividends. The book emphasizes the importance of dividends in generating superior stock returns, suggesting that stocks with sustainable cash flows and consistent dividends often yield better returns. Historical data shows that strategies focusing on high dividend yields outperform broader market indices like the S&P 500. It also notes the significant role of certain industries, like oil and tobacco, in these strategies. Further, it suggests that real estate investment trusts, REITs, should be part of a well-balanced equity portfolio due to their high yields. International. The book recommends diversifying investments globally, especially in the face of shifting economic power towards developing countries like China and India. It warns against over-investing in fast-growing countries due to the growth trap, but encourages investment in global firms that derive income from multiple countries. Valuation. The author stresses the importance of buying stocks at reasonable valuations and avoiding overhyped or overvalued stocks. Various strategies are discussed, including investing in sectors like oil, healthcare, and consumer staples, which have historically offered good returns. The book also endorses a strategy of investing in low price-to-earnings ratio stocks and highlights the impressive performance of Warren Buffett's Berkshire Hathaway as an example of successful value investing. In conclusion, the author believes that while indexing should be a core part of one's portfolio, these additional strategies based on dividends, international diversification, and careful valuation can enhance returns. The future. Despite uncertainties like the aging population in developed countries and rapid growth in the developing world, is bright for equity investors who follow these disciplined, value-oriented strategies.